Okay, so let's talk about financial planning models, and we're going to get started with that. All right. Uh, the ingredients, obviously, sales forecast is the main thing. When we're talking about growth, we want to grow sales. That means more income, more profit, everything else. So sales is the driver of everything of our planning. So that's the main thing you want to remember. Sales is our driver here. The next, like we said, we're going to do our pro formas, the worst case, most likely case, best case scenario, to see these interactions, and that'll give us an opportunity to really get in there, see how they're fitting, see what's going to happen to our financial decisions, financing decisions, and what we need to do. Okay. Um, that sales forecast and those pro formas let us know if we need assets. Um, if the ones we currently have will meet those, and if not, we got to go out and get them. Then again, we talk about the money requirements on that side. Um, you know, do we need to go out and get money? And the thing that we're looking for here is our plug variable. The plug variable is whatever we decide that will make our balance sheet balance. Okay. Um, the other thing we have to have in these when we do these scenarios, and you want to write these down, are what economic assumptions do we think is going to happen. So we look at, hey, the economy's been going strong. It's been going strong for a number of years. We think that might continue for another year, and then we're going to taper off and see a little bit of a recession or whatever. We think interest rates are going to remain low, or when do we think interest rates are going to pop up? What rate do we think it's going to be at? And all that's going to affect our cash flow. Okay. So let's get into this example. And you see you got the Gourmet Coffee Company here. Here's their balance sheet. So they have $1,000 in assets. They have 400 in debt, 600 in equity. So you can see it balances out pretty easy. Okay. And we're going to keep this very simple for right now. Here's their income statement: 2,000 in revenue, 1,600 in costs, and 400 in net income. Now, their initial assumptions: revenue will grow 15%. All items are tied directly to sales. Those relationships are optimal. Okay, so all the items are going to grow 15%. That would be lovely. Now, we look at this and we go through here and we can see, so their pro formas, their revenues are going to go to 2,300. Their costs went up to 1,840, and their net income went to 460. Now you need to pay attention to this 460 number. Keep that in mind as we go through the next slide here. Okay. So we're going to talk about the plug. All right. So you can see here is their balance sheet, and obviously assets went from the 1,000 to 1,150. Now, quite honestly, folks, there's only one reason assets go up when sales go up automatically. And think about this. It's kind of it's intuitive there, but if you couldn't increase sales without getting more assets, then the thought is your assets are running at full capacity. Okay, so in essence, this coffee shop, they couldn't sell a single drop of more coffee or another cup of coffee unless they went out and got another coffee maker or something like that. Okay, now you can see where our debt went up with the sales. Okay, we expected that. Now the equity went up also, and this is where I needed you to remember the number from the net income. Okay, we can see equity went up $90, and the question here is, where did that equity come from? Okay, that came from retained earnings. Where does retained earnings come from? Net income. So if we had 460 in net income, right, and 90 of that went to retained earnings, which popped over to our balance sheet right here. Okay, that's where the equity went up from 600 to 690. Then we have 370 left, and that went to dividends. Okay, So in this case, our plug number, what made our balance sheet work, was the fact that we paid $370 in dividends. Okay, now let's look at another example here. You can see obviously the assets increased again. Notice now though what happened to our total debt, okay, and then see what happened again to our equity. We can see our equity went up $460, which was our net income. So that means all of this went to retained earnings and none of it went to dividends. So had we had our 400 total debt, if we hadn't changed our debt, then we would have been over on our total liabilities here. So in this case, our plug was the fact that we paid $310 in debt. So we reduced our debt by $310. Okay. So hopefully you can follow that, and that wasn't too bad.